If you are 65 or older and you have a bank account in America, your bank is quietly filing reports about your money to the IRS. Not because you did anything wrong, not because you are in trouble, because federal law requires them to file forms you never see. And in 2026, 3 mistakes that most seniors make are causing those reports to trigger audits, freezes, and levies at a rate I have never seen before. I spent the last month in IRS publication 594, the Bank Secrecy Act Enforcement Manual, and the FINRA regulatory notices for this video. What I found is that most seniors believe their bank account is private. It is not. Every deposit, every dollar of interest, and every digital payment is tracked, reported, and matched against your tax return by a computer that never sleeps. The first mistake hides in your mailbox every January. The second mistake has been a felony since 1986. The third mistake starts with a letter that looks like junk mail. I will show you all 3, and I will show you why your bank teller is legally forbidden to warn you about them. Here is the first mistake. It hides in your mailbox every January. Your bank is required to report all interest income on Form 1099 INT to the IRS. There is a $10 threshold for when they must file, but many banks report every penny. If you earned $22 in interest on a savings account and forgot to include it on your tax return, the Automated Underreporter program flags a mismatch. A computer generates a CP 2000 notice proposing additional tax. Most seniors throw that letter away because the amount is small. But the letter is not a bill, it is a warning. And ignoring it is the first step toward a bank levy. A retired postal worker in New Mexico named Raymond got a CP 2000 notice for $31. His regional bank had reported $31 in interest on a certificate of deposit that matured in 2024 and rolled over automatically. Raymond did not include it on his return because $31 seemed too small to matter. The IRS proposed $4 in additional tax plus $8 in penalties. Raymond threw the notice away. 6 months later, the IRS assessed the balance. 3 months after that, they issued LT11. Raymond was visiting his grandson in Colorado when the letter arrived. By the time he got home, the 30-day window had closed. His bank froze his account for 21 days. The levy was $295. The bank charged a $125 processing fee. Raymond paid $420 because he ignored $31 in interest. That is how the system works. Small mismatches become large problems because the timeline is statutory and it does not wait for you to get home from vacation. I spoke to a tax professional in Colorado who told me that in 2026, nearly half of his new senior clients had unreported interest or dividend income, not because they were hiding it, because they did not know it was reportable. The banks do not send a warning. They send a 1099, and the 1099 goes to the IRS before you see it. If you have 3 savings accounts at 3 different banks, you get 3 1099 INT forms. If you forget one, the computer finds the mismatch. It does not matter that the amount is $15 or $150. The mismatch is the trigger. And the trigger starts the same collection sequence whether the amount is $31 or $31,000. The CP 2000 gives you 30 days to respond. If you do not respond, the proposed tax becomes an assessed balance. The IRS adds penalties and interest, then they send CP 14, then CP 501, then CP 503, then CP 504, then LT 11 or letter 1058. The final letter gives you 30 days to file Form 120153, the request for a collection due process hearing. If you miss that window, the levy is issued. The bank receives Form 668B. Your account is frozen for 21 days. On day 22, the money is gone. The bank sends it to the IRS. And there's no limit to how many times they can do it. If the first levy does not satisfy the debt, they issue another one, until the account is empty. If you are 65 or older and you just realized the IRS is reading your bank deposits while you sleep, hit subscribe. We find the rules buried in government manuals, and we show you the form that stops them. Every video is built from actual IRS data, actual court cases, and actual enforcement actions. Subscribe and turn on the bell. Now I want to show you the second mistake. This one is not a tax error. It is a federal felony, and it starts with the best of intentions. A retired farmer in Kansas named Lloyd sold his combine harvester for $11,500 in cash. He walked into his community bank and asked the teller if he should deposit the full amount. The teller told him the bank would have to file a report if he deposited more than $10,000. Lloyd thought he was being smart. He deposited $6,000 on Monday and $5,500 on Wednesday. He stayed under the line, he avoided the form, and he committed a felony. Under the Bank Secrecy Act, every bank must file FinCEN Form 104 for cash deposits over $10,000. The threshold was set in 1970. If adjusted for inflation, it would be roughly $80,000 today. But Congress has never updated it. The bank does not ask your permission. They do not send you a copy. They file it automatically. Most seniors know about the $10,000 rule. What they do not know is that trying to avoid it triggers a suspicious activity report instead. When Lloyd broke his deposit into two pieces, the bank's algorithm flagged the pattern as structuring. The SAR went to FinCEN. FinCEN shared it with the IRS, and the IRS initiated a civil asset forfeiture proceeding that froze Lloyd's entire account. Not just the $11,500, the entire account. More than $16,000. It took 13 months and $5,200 in legal fees to get it back. He was never charged with a crime he did not need to be. Under 31 U.S. Code, Section 5324, the crime is the act of breaking up the deposit itself. Intent does not matter. The algorithm does not know your intentions. It only knows the pattern. I have been reading these manuals for a month, and this is the part that still makes me angry. The $10,000 rule was written when Nixon was president. The threshold has never been adjusted for inflation. Banks file millions of currency transaction reports annually. But the law is still $10,000. And retirees who sell equipment, a car, or an inheritance are still triggering the same reports as criminals. If you have legitimate cash to deposit the full amount regardless of the $10,000 line. The CTR is routine. The SAR is dangerous. Documentation is your only defense. The bill of sale, the estate letter, the closing paperwork. Keep it. Because if the algorithm flags you, you're explaining yourself to a computer that does not listen. Now, I want to show you the third mistake. This one hides in your work, even after you retire. If you earn $600 or more in non-employee work from a single client, that client must issue a 1099 NEC. That form goes straight to the IRS. And if you do not report that income on your tax return, the Automated Underreporter program flags it automatically. But here's what most seniors do not realize. The $600 threshold is per client, not per year total. If you earn $500 from 5 different clients, none of them issue a 1099 NEC, but you still owe tax on the $2,500 total. And if the IRS audits you, they do not care that no single client crossed $600. They care that you did not report the total. A retired architect in Oregon named Stanley did $3,200 of consulting for a local developer in 2026. The developer paid him $1,800 in March and $1,400 in September. Because neither payment crossed $600, the developer did not file a 1099 NEC. Wait, that is wrong. Both payments crossed $600. The developer should have filed. But the developer forgot. Stanley assumed no form meant no tax. He deposited the checks into his credit union account. He reported zero self-employment income on his return. In August, the IRS Automated Underreporter compared his bank deposits to his tax return. The system saw 3 $2,200 in consulting deposits, but zero reported income. The mismatch generated a CP2000 notice proposing $380 in additional tax, plus $77 in penalties. The notice arrived while Stanley was fishing in Idaho. By the time he got home, the 30-day response window was half gone. He called me after he saw my last video. I told him the same thing I'm telling you now. The government does not care that your client forgot to file. They care that your tax return matches your deposits, and your bank deposits are one of their records. But the 1099 NEC is not the only form that watches your work. Your bank is also reporting your interest, and the combination is what catches seniors off guard. A retired nurse in Washington named Patricia did $2,400 of tutoring in 2026. She also had $48 in interest from a savings account she forgot about. The tutoring deposits triggered a 1099 NEC mismatch. The interest triggered a 1099 INT mismatch. The IRS sent 2 separate CP2000 notices. Patricia responded to the first one but missed the second because she thought it was a duplicate. The second notice became an assessed balance. 3 months later, the IRS issued LT11. Patricia was at her daughter's wedding in California when the letter arrived. By the time she got home, the 30 days had expired. Her bank froze her $14,000 savings account. Her Social Security deposit was seized. She lost $465 in total because she missed 2 small notices. The bank did not call her before they processed the levy. They received the notice. They froze the account. They sent a letter a day later. By then, her checks had already bounced. Now I want to show you something most people never think about. The IRS does not just wait for your bank to send them forms. They can take them. Under 26 U.S. Code Section 7609, the IRS has the authority to issue a summons to your bank, demanding records of every deposit, every withdrawal, and every transfer for up to 3 years. Your bank must comply. They cannot refuse. And they do not need to call you first. Once the IRS has your records, they conduct what is called a bank deposit analysis. They add up every deposit that is not a documented loan, a transfer from another of your accounts, or a gift with a letter. If the total exceeds what you reported on your tax return, they assume the difference is unreported income. The burden shifts to you to prove otherwise. You're guilty until you prove yourself innocent. And most seniors do not keep the records to prove it. The only defense is documentation. If you receive a large sum that is not income, keep the paper trail. The estate letter, the loan agreement, the refinance statement. Without it, the IRS assumes it is taxable. If you sell a personal item at a loss, keep the original purchase receipt to prove you did not have a gain. If you receive a gift, keep a letter from the donor stating the amount and the date. If you receive a loan, sign a promissory note with repayment terms. These documents are your shield if the IRS ever comes knocking, and they are worthless if you create them after the fact. You must create them when the transaction happens. Now I want to show you the rule that locks your account without a court order. It is the bank freeze rule. And in 2026, banks are using it more aggressively than ever. Under FINRA Rule 2165, banks must place a temporary hold on disbursements from the account of a specified adult age 65 or older if the firm reasonably believes financial exploitation may have occurred. The hold can last up to 15 business days. It can be extended by a state regulator for another 10 business days. That is 25 business days total. During that hold, you cannot access the funds. Your checks bounce, your mortgage payments fail, your Social Security deposits hit a frozen account. And the bank does not need to prove exploitation occurred. They only need a reasonable belief, a large withdrawal, a new joint owner, a wire transfer to a grandchild. Any of these can trigger the hold. I spoke to a consumer protection attorney in Tampa named Karen Walsh. She told me about a 79-year-old woman named Helen who had $18,000 in her checking account at a regional Florida bank. Helen added her granddaughter as a joint owner so the girl could help pay utility bills while Helen recovered from hip surgery. The bank saw the new joint owner and a $9,000 wire transfer to a home health agency. The algorithm flagged both events. They placed a 15-day hold on the entire account. Helen's Social Security deposit hit the account 3 days into the hold. It was frozen. She could not pay her Medicare premium. She could not pick up her prescriptions. She spent 4 days on the phone with the bank's compliance department before they released the hold. The granddaughter was not a fraudster. The home health agency was legitimate. The bank's algorithm did not care. Karen told me that Helen's case was not unusual. She handles 4 to 5 similar cases every month. Banks are terrified of elder fraud lawsuits, so they err on the side of freezing first and asking questions later. The customer pays the price. And in 2026, with elder fraud complaints rising, banks are triggering these holds more often than ever before. What used to be a rare exception is becoming standard procedure. The definition of reasonable belief is intentionally vague. A teller who thinks you look confused, a branch manager who misreads a wire transfer memo, a new software update that flags joint accounts with large transfers. Any of these can lock your money for 15 days, and if the state regulator extends it, you are locked out for 25 business days. That is 5 full weeks, 5 weeks of bounced checks, 5 weeks of missed mortgage payments, 5 weeks of explaining yourself to a bank that already has your money. If you just realized your bank can freeze your entire account for 15 days without proof, without a court order, and without warning you first, hit subscribe. This channel is a warning system, not entertainment. We read the enforcement manual, so you do not have to. Subscribe and turn on the bell. Now I want to show you the trap that starts with love. It is the joint account and payable on death designation, and it is the one that locks your family out of your money after you're gone. A senior adds an adult child to a $15,000 account, so the child can pay bills if something happens. It seems smart, it seems protective, but under the law, that child now owns half that account. Not when you die. Right now. And if that child gets divorced, the $15,000 is marital property. If that child is sued, the $15,000 is attachable. If that child dies before you, their heirs own half your account. And there's no way to undo it without the child's signature. I found a case last month in a legal forum. A retired engineer in Colorado named Richard had $16,000 in a joint account with his daughter. The daughter was sued by a former business partner over a contract dispute. The partner's attorney subpoenaed every account with her name on it. The $16,000 was frozen during the proceedings for 9 months. Richard could not access his own money. He had to take out a home equity line to pay his property taxes. The daughter eventually settled and the account was released. But Richard learned a lesson he should never have had to learn. The retitling cost nothing. The lack of retitling cost 9 months of financial stress and a relationship strained by lawyers. The fix is a convenience account or a durable power of attorney. A convenience account allows the child to write checks but does not give them ownership of the balance. At your death, the account passes to your named beneficiary, not to the child. If the child gets divorced, the convenience account is not marital property. If the child is sued, it is not attachable. The joint account is all of those things. And the difference is one form at the bank, one signature, 5 minutes. The money you worked for is either protected or exposed based on that decision. For your payable on death designations, verify that the named beneficiary is still alive, still competent, and still the person you want to receive the money. If your POD beneficiary is your spouse and your spouse dies before you, the POD fails and the account goes to probate. If your POD beneficiary is one child and you have 3 children, then one child receives the entire $16,000 regardless of what your will says. The POD designation overrides the will. If you named your ex-spouse as POD beneficiary 20 years ago and never updated it, the ex-spouse gets the money. The bank does not check your divorce decree, they check the POD form on file. A retired chef in Louisiana named Marcus discovered this the hard way. His wife died in 2023. He never updated the POD beneficiary on his community bank account. The form still named his ex-wife from a marriage that ended in 2001. When Marcus passed away in 2026, the ex-wife received the $13,000 balance. His 2 children got nothing. The bank did not check the divorce decree. They checked the POD form. The children spent 10 months in probate court trying to recover the money. They spent $2,800 in legal fees. The ex-wife kept the account. The fix is free. Call your bank. Ask for the current beneficiary designation on file for every account. If it is wrong, fill out a new beneficiary form. It takes 5 minutes per account. It prevents months of probate delay. It prevents the wrong person from receiving your money. And it prevents the bank from locking your family out of cash when they need it most. The wrong name on a form can cost your family thousands in probate fees and months of waiting. The right name costs nothing. Now I want to show you why these traps are worse together. A retired couple, both over 65, with $15,000 in a low-yield savings account, a joint checking account with an adult child, and a consulting gig that generated a 1099 NEC they did not report. If they do nothing, the first-year cost is devastating. The cash loses $375 to inflation while earning $91 in interest. The 1099 NEC triggers a CP 2000 notice. They do not respond in 30 days. The tax becomes an assessed balance. The IRS issues LT 11. They miss the 30-day window. The bank freezes the account for 21 days. The Social Security deposit is seized. The joint account is frozen in a lawsuit 6 months later. The POD designation names an ex-spouse who has not been seen in 20 years. The $15,000 is gone, not in one dramatic event, in 5 small events that build on each other, each one manageable alone. Together, they are a financial collapse. But if they act before the calendar turns, the savings are immediate. The cash moves to a high-yield account at 4%, generating $600 instead of $91. The 1099 NEC income is reported on the tax return before the IRS flags it. The joint account is retitled as a convenience account. The POD beneficiary is updated to the correct child. The tax return is filed with all income reported. The IRS has no mismatch to flag, no CP 2000, no levy, no freeze. The money stays where it belongs, in your account, under your control, available when you need it. I wrote the quiet rules because I kept seeing the same pattern. Seniors losing money not to scams, not to market crashes, but to paperwork they did not know existed. The manual is not a generic retirement guide. It is a response plan for these exact traps. It has the documentation list for large cash deposits. It has the Form 153 filing instructions. It has the phone script for your bank's fraud department. It has the convenience account language. It has the beneficiary change form. It has the 1099 NEC reporting checklist. If you are serious about protecting your account before the next rule changes, the manual is at kevinexplains.shop. Most people who use it save 10 times what they pay. That is the guarantee. If you are watching this for a parent or a spouse, send them the link. One share takes 10 seconds. If they have a bank account, they need to know what is watching them. Now, let me bring this to the specific actions you need to take. I have 5 of them. The first is the one that will save you the most money in the shortest amount of time. Move your cash to a high-yield account if your rate is below 3%. The difference between 0.61% and 4% on $15,000 is $509 per year. That is $42 per month. For a retiree on Social Security, $40 is medication. It is heat, it is groceries, and it takes 10 minutes to move. Second, gather documentation for every cash deposit you made in the past 12 months, the bill of sale, the estate distribution letter, the closing paperwork. If you sold a car for $12,000 and deposited it in pieces, you're in the algorithm's crosshairs. Create a folder, label it Cash Deposits 2026, put every receipt in it. Without that folder, you're explaining yourself to a computer. Third, call your bank and ask for the current beneficiary designation on file for every account. Do not assume you know what is on file. Ask them to read it back to you. If it names a deceased spouse, an ex-spouse, or the wrong child, fill out a new form immediately. It takes 5 minutes per account. It prevents months of probate delay, and it prevents the wrong person from receiving your money. Fourth, if you have a joint account with an adult child, ask your bank about retitling it as a convenience account. If your bank does not offer one, set up a durable power of attorney instead. The child can write checks, but does not own half the balance. If the child gets divorced or sued, your money is protected. The difference is one form, one signature, 5 minutes, and it can save you thousands in attorney fees. Fifth, if you received any 1099 NEC or 1099 INT forms in 2026, verify that the income is reported on your tax return before you file. Do not wait for all the forms to arrive. Some payers file late, some forget entirely. You are responsible for reporting the income whether you receive the form or not. Compare your bank deposits to your tax return. If the deposits exceed the reported income, find the gap and report it. The gap is what the computer sees, and the computer does not forgive. I do not know your exact bank, your exact state, or your exact situation, but if you email me at kevinexplainsofficial@gmail.com, I will personally review it. Small fee. Most save 10 times what they pay. I have seen enough cases to know that the seniors who act fast keep their money. The seniors who wait lose it. And the difference is usually one phone call or one form. The rules are not going to get simpler. The computer is not going to get slower. The thresholds are not going to adjust for inflation. Your only defense is knowing what the computer sees before it sees it. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.